Welcome, everyone. My name is Julius Ellis, and this is Vanessa Peters, MD. And we are here to really have a conversation about Vanessa's new book that got released in May on audible.com. And the name of the book, you have the book in front of you, but Vanessa, it is The Busy Professional's Guide to Passive Real Estate Investing, a physician's path to building wealth, creating financial freedom, and leaving a legacy. It is about leaving a legacy.
Thanks for having me. So
Yeah,
excited to be here. Thank you.
it's really great. So I had the honor of narrating this book and I got to learn so much. I have knowledge of real estate investing, but it's another thing to go, this is a whole nother level that that a lot of people may not know about. And I'm curious, Vanessa, like to kick this off, what had you even write this book? And
Basically, my background is I'm a medical doctor and I just celebrated my 20th year at my job. And it is a job, it's a W-2. I am not my own boss like I thought I would be when I became a doctor. When I was, going into college, I was like, I'm going to be a doctor and I'm going to be my own boss. That's not exactly how it works. And so it did, but I'm still here because I still have a passion for medicine and my patients. I'm a primary care physician and I live in San Diego County. So I have been at the same position for 20 years since I got out of residency. So that's, in itself is kind of crazy, especially with all of the kind of recent talk about, switching jobs and getting a better pay and all these things. And I guess I'm just really loyal and I also just like it at this position. And I've worked my way up as well to be the sort of like the medical director for our group. And so I do have a pretty good chunk of like administrative time as well in the day. And so I see patients and I do meetings and I'm trying to help the other physicians in our clinic have a better life and have, better processes. And, I like the organizational part of things as well to try and make sure that we're efficient. So, I've always loved doing that, but I got to a point in 2018 where I realized that what I was doing with my finances was not tenable in terms of where I wanted to go. I realized that, I'm saving a lot of money. I'm putting away half my income. I'm earning a good income, trying to keep my expenses low. And after, about 4, 5, 6 years of doing that, I graphed it out in Excel and saw that the amount of my net worth was definitely going up. But when I did the delta between the years of how much it was going up per year, and then I compared that to what I was saving, I was pretty much shocked to see that it was very similar. The numbers between what I was saving and what my net worth was increasing was almost the same. I was like, I must have done the numbers wrong. This can't be right, because your net worth is supposed to go up in exponential fashion because of compound interest, right? And so when I went back, I looked at the numbers, everything was correct. And this is when stocks were going up. So I was just kind of flabbergasted to see that. And I was like, oh my gosh, I'm doing everything I can. The only thing I can do is work harder. I can see more patients, I can work longer hours, but that's a trade-off for being with my family and the other things I wanted to do in life. And so I was like, there's got to be another way. There's got to be another way. And I just had this kind of like remembrance of real estate and how that is the way to build wealth. And at the time, I had one rental property that I had purchased in 2008. It was kind of like a one and done kind of a thing. I did it and it was kind of scary. And then 10 years later, I look up and I was like, oh my God, this thing doubled in value. I should do that again. And I had also read Rich Dad Poor Dad when I first got out of residency. And I, kind of remembered that. I was too scared to jump in at the time, but I knew that that was the way to go. So that got me back into real estate, and finding a way that worked for me to invest in real estate was really my journey over the next year.
wow, that's amazing. Especially what you're referring to as wanting to spend more time with your family and thinking that you've got to work harder. And that seems to be the source of what could be possible with investing, and especially in the things that you mentioned in your book, which are mind blowing. Really, they're life blowing. They give you access to time, family, what you want to newly want to take on in your life. All of these things that we all talk about what we want, but is it really happen, right? And so that brings me to looking at one of the topics you go into in detail is syndication. And then really, what is that investment in syndication? I mean, if you were to just kind of give a brief overview of that, and
Right.
and how, and you're an MD, so this book is targeted to MDs, and yet when I read it and when we had conversations over email, it really is all encompassing. It's not just MDs. It's really from your POV of being an MD. But yeah, what
Mhm.
is syndication? And it can be for everyone, not just MDs, right?
Absolutely. Yeah. I named my book The Busy Professional's Guide to Passive Real Estate Investing. I didn't name it The Doctor's Guide because there's another book out there with almost that title, number one. And number two, I didn't want to exclude a whole bunch of people because I do feel like it's anybody who is busy, is professional, and has usually a good income. Those are kind of the criteria. Not to say that you can't work your way up, but that's a different path through real estate, right? So what I started with my and I'll get to what syndication is, but I want to explain what it's not, right? And so when I first started thinking real estate is the way for me, I'm going to, change the trajectory of my savings and my net worth and all that. So of course I thought, well, I'm going to buy another house. I already had a house. It was rented out. It was doing well, and I'll do that again, right? So in 2018, I looked all over San Diego County where I live. I looked all over Riverside County where I had a house already and couldn't find a single thing that worked for me. They were too expensive. The rent really didn't make sense, what I would earn in rent versus what I would pay for the house. And I was like, oh crap, this isn't going to work. What is everybody else doing? So I started going to online forums. I started going to in-person meetups. This was before COVID, thank goodness. And so I was meeting a bunch of people at meetups, and what are all the California people doing for real estate? Well, they're going out of state. Okay, well, that makes sense. You got to invest out of state where it's more affordable. And most of the people were doing things like homes or duplexes out of state. So they would buy something in Memphis, Tennessee, or Kansas City, or some other market where it was much cheaper. So the homes are like 150K instead of 300, 400, right? 500.
Yeah, yeah.
And of course, the rent is lower too, but they're more affordable. So I thought about that for a while and realized that that wasn't really what I was looking for. It felt risky to me because I knew what it was like to own a rental house. And I thought doing that out of state, in a place I don't even know, I'd be totally reliant on property managers. And if I don't know the area,
Mhm.
as you know, if you know an area well, you know that street A is good, street B is bad, street C is good. You just don't know that kind of stuff if you don't live there. And I wouldn't want to purchase a property and have it in a bad neighborhood. So I thought that's not for me. I got to keep looking. And I started looking at small multifamilies to purchase myself. Way too expensive. I couldn't afford it. And this word syndication kept popping up as I was on the forums. I ignored it for quite a while because I was like, that doesn't mean anything to me. All that means is like Seinfeld reruns. That's all I could think of for like syndications, like syndicated sitcoms, right? And one time though, after a few weeks, I found a post by a physician about syndications. And I thought, okay, maybe I better look at this. I've seen this a couple times now. And when I started reading about syndications, I still didn't quite understand what it was. I went online, did a Google search. There was nothing to really tell me what it was very clearly. So I basically reached out to somebody who had replied to the thread that I originally saw and had mentioned a couple things. I was like, he sounds knowledgeable. I'm going to call him.
Mhm.
So I called this gentleman, and we get on the phone and we talk, and he explains to me what a syndication is, and the light bulb went off, and I was like, oh, really? Well, if this is for real, this could be awesome. So what a syndication is basically a pooling of investor money to purchase a very large asset. It doesn't have to be very large, but minimum $5 million asset to make it worthwhile, because there's a lot of legal fees and paperwork that goes into this. So picture someone wants to purchase an apartment building, and the building is $50 million. They want to buy the building.
Five
There's
zero, right? You said
five
five
zero,
zero,
yeah,
right?
five
Right, right.
zero million.
Yeah.
And so there's usually a couple of general partners. That's what they're called. People who want to buy the building. They want to operate, manage it, and flip it. So syndications in multifamily space are primarily a long flip, meaning we all know what a flip of a single family home is. You fix it up, you sell it in 6 months. Well, this takes longer because you've got 200 units, right? So you're basically buying a building that's a little bit older usually. It needs to be refreshed. The countertops aren't very nice. The lighting's not very nice. The carpets, the floors. So it's like a superficial upgrade. You want to buy a building that has great bones, meaning the plumbing and electrical and the roofs are good. But the superficial stuff can definitely be improved. So they want to purchase a building, but they need a 20% down payment at least. And then they need a budget for construction. So that's getting pretty expensive now. And they probably need to raise money for that. So raising money from limited partners is where the rest of us come into the picture who aren't actively doing real estate. We can participate in these deals. We can put in as little as 25 or 50K and just basically invest in a deal and in return receive a small percentage of ownership of a building. So the question I commonly get asked is this a REIT, a real estate investment trust, I think is what it is.
Yeah.
So no, this is not a REIT at all. It's completely different from a REIT. A REIT is something that's usually on the stock exchange and it's public and you can get in and out of it very quickly. It's very liquid.
Yeah.
On the other hand, it has good returns as a REIT, but it's not the same kind of tax advantages you're going to see. If you own a piece of an actual building, all of a sudden you have tax advantages, just like you purchased your own property, including depreciation. Depreciation is a beautiful word. We love that. It's losses that come against our income. Not our active income, but our other passive income. And so that's beneficial. And then the beauty of it is that you don't have to do any work. So you're not expected to, and you're not allowed to. So as a limited partner, you're limited in your liability. If something happens to someone, a tenant or something like that, you have zero responsibility. And so your risk is limited to the money that you put in. And if you pick a good trustworthy operator, then the risk of losing your money is extremely small. So when I learned about syndications, I said, this sounds pretty interesting. I like this idea. And the returns are amazing. They're pretty darn good, even compared to what you might see if you purchase your own house, but you don't have to pay for all the things that can go wrong. If you buy a house and then the water heater goes out or the air conditioner goes out, there goes your profits for a couple of years, because that's a big ticket item. And if you're only making a couple $100 a month in profit, then that can really be a problem. So you get your preferred return on a syndication. So you give them your money, they provide you in return, usually a preferred return of 7% annually. And so you get that on a monthly or a quarterly basis. And then it's building up equity. They're increasing the value of the property. And then when they sell it in 3 to 5 years, most of the pro formas are for 5 years, but it can go sooner than that, as I have experienced. Then you receive your original capital back plus the equity in the deal. So that's basically what a syndication is. And when I found out what it was all about, how it worked, I flew out to Dallas and I looked at a building before I did any investment. And so my very first investment, I flew out there to look at it, make sure it was a real thing, because, doctors get scammed a lot. And so we have to make sure that our investments are safe. And I did a gut check and met all the people involved and felt good about it. So once I did that first investment, started receiving that return, I was pretty much hooked from there.
That's amazing because you have a quote with all of what you just shared. It says, unlock the golden handcuffs of your high paying job. And that's exactly what it starts to do, because you go into the book and when I was reading it was like, this is your first year, this is your second year, and this is what it can look like in 8 years. And it's a sustainable regenerative process. And the fact that you get that capital back plus when you invest your initial investment and then the 7% or whatever, and then it could go, you said, 3 to 5 years and oftentimes more. So then that's such a great opportunity. And so
Yeah.
from there, you really, and then you had your experience with your first one. And then after that, did you say you were hooked a little bit, or you're like inspired?
Absolutely. Within 6 months, I had done like 5 or 6 more deals. I mean, maybe that was a little impulsive of me, but I think I had been looking for the right type of investment. And when I hit on it, I was all in. I took some money away from a 401k and put it into a self-directed 401k and invested that money. Then I took a bonus that I received that year and I took some savings, and I didn't put it all with the same people. I diversified. So it's very important to, like, think of what happened with the poor folks who invested with Bernie Madoff. Right. He had a Ponzi scheme, which means that he was investing money and then using the new investors' money to pay off the old investors. And they were getting checks and it was all good until it wasn't. Right. And there was nothing to back it up. And I've read a story about a woman who had all of her life savings with him. And so that's devastating, right?
Yeah.
And there are bad actors out there. And so we have to be careful. And the way that I mitigate that risk is by investing in different markets, different states, different asset classes, and with different operators, just in case. You can't ever know for sure.
And that's so great. What is something that you look at or vet to know the operator that you want to collaborate and be in partnership with? There's some key things that you look for?
Yeah, I mean, you can do a formal background check, but that is difficult because you need to have a social security number for that. But you can do a pretty detailed Google search on somebody and type in SEC, Securities and Exchange Commission, and their name. Any litigation, any legal stuff will pop up. And then you dig into their track record. So you'll receive their track record, and then you can review their previous deals. You can confirm them. You can ask for references. I'd like to speak to investors who've exited a deal, so that you can confirm that people are getting paid out correctly and all that sort of thing. I personally, now that I've been doing this for, going on 4 years, I only work with a handful of operators that I know and trust. So initially, yeah, you do have to have a certain leap of faith after you do your due diligence that these people are good people. And then once you develop those relationships, it just gets easier and easier because you're reinvesting with the same people.
Yeah, what you shared in the book too is about doctors having that propensity for research. And obviously, Vanessa, you have that strength, superpower for research and really looking at everything. And so now that you have a handful of people that you work with, that's so great because you have your company, VMD Investing, and people can jump in with you. I mean, and actually look at the deals that you've done all the work for, right? You've done the research, you've vetted a lot of the people, and you've been in this 4 years. But you said in that first month you had, how many things? 5, right?
6. And the first 6
6.
months I had 6 deals. Yeah.
Six,
Yeah. So one
oh,
deal a
6 months.
month
I
was,
was thinking
yeah.
1 month, 5. Okay, 6 months.
Yeah. Yeah. Yeah.
All right.
Yeah.
So and so, really in looking at 5 years, 5 years consistent. Now I'm looking at 5 years consistent. I invest, let's say I'm an investor, 50,000, 5 years, limited partner. What is the trajectory for that?
So in the roadmap to financial freedom that I created, which is a spreadsheet, because I love calculators in terms of mortgage calculators and loan calculators. And I always want a calculator for not just paying down debt, but to growing your net worth, right?
Yeah.
And I couldn't find any kind of calculator that would tell me, okay, you're on this path, what's going to happen? And of course, nobody can predict the future. But if you take some assumptions into account, which would be a 7% preferred return, a 5-year hold, and doubling your money in that 5 years, meaning a 20% return per year. You get that preferred return of 7%, but that's just the beginning. The real money comes when you exit with the equity. So when you get that equity back, it should be 20% per year that you've received. And so if you take those assumptions into account and invest per year, the calculator, you can plug it in. And in my book, I did an example of $100,000 per year. And after 8 years, you have about $100,000 in passive income. And that passive income is just the preferred returns. It's not the equity. But the reason that it turns into a snowball that grows is because the other assumption that's super important is reinvesting all of your returns. So if you keep that money aside and you're not living off of it, you can really grow things up to the point where you could switch and stop reinvesting everything and start living off of that passive income. So that's where you would meet maybe the crossover point in your life, which is, what are my expenses and what is my passive income? When they match, then you could leave your job if you chose to.
And you work with people on that then to see what their lifestyle is going to be, their self-expression and what they're committed to in their life. And so you work that out one-on-one with them.
I do a
Right?
little bit. I don't have a formal program for that, but people will often ask me, what, what do you think I should do
Okay.
next and
Yeah.
things like that. But I'm not a formal
Absolutely.
advisor. Yeah.
Yeah. But that's
Mhm.
fun. I mean, that's fun because you have choices. And that's, who would not want to have choices with money? It's so amazing. So yeah, so thank you so much. I mean, I wanted to have a quick chat with you and just say it was really fun for me to narrate something that is something that I'm not really familiar with, but something that I practice, like you said, in the single family home investment. And I have more knowledge about that. And there's a lot of books about it. There's a lot of people doing things. And then what's possible, especially for the folks in California, for us
Mhm.
to look and see. So thank you so much, Vanessa. It was great to connect with you today.
Yeah, absolutely. Thank you for having me. I really think that passive real estate investing is a great way to go for those busy folks who, buying a home and renovating it is a big deal. Buying a home and renting it is a big deal. Short-term rentals are very, very active. And so if you take a close look at what you really want out of your investment, if you love real estate and you want to be active, go for it. But if you would really prefer to focus on earning money in your field of choice, and then having some income come in on the side, this is a great option for that.
Great. So people can get connected with you online at VMD, that's Victor Mike Delta Investing.com.
That's correct.
Awesome.
Yep,
All
absolutely.
right, everyone, and keep up the great work, Vanessa. Thank you so much.
Thank you for having me, Julius.